Afternoon, MED Pension Committee meeting. Call it to order. It's not on our agenda, but let's do what we normally do a quick prayer and a pledge of allegiance. Dear Heavenly Father, be with us today as we make our decisions. We thank you for all the blessings that we have in our city. We pray that you're with us as we go forward during this day. In Jesus' name, amen.
Allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
All right, first order of business, we'll consider the minutes of our July 28th, 2020 meeting.
I don't believe that the paragraph on page 2 that starts out with Ms. Wright made a motion to approve MED's pension plan reflects the actual recording of the minutes. I'd like to play that, if that's okay.
I don't know if we have the recording.
I got it right here.
Oh, do you?
Yeah. Is that okay?
Can you play it loud enough for everybody to hear you?
I'm going to try to pull the mic down.
Well, let's see. If you get feedback, you're on your own, Jackie.
All right, I'll stick my fingers in there.
Yeah. So which paragraph are we talking about?
Hold on just a second.
I think he said paragraph 3 on page 2.
Yeah, it starts out with Ms. Wright. And I know that, we were called by the city attorney and said, well, what we approved can't do, but I would think the minutes need to reflect it, and then we would change it in the pension meeting. So let me see.
This is Mrs. Wright made a motion to designate human resource. Mrs. Wright made a motion to approve the MED pension plan as amended and revised
Yes.
with additional language inserted in the plan and draft in the plan document to clarify that no benefit would accrue under the plan after June 30th, 2020. And Ms. General seconded the motion. After a brief discussion, the motion was unanimously approved. So how would you suggest?
Well, during that discussion, it was discussed about the MED employees receiving the last year as far as considered on the monthly benefit calculation.
Right.
And that was approved during this time period on the tape, and it doesn't reflect it in the minutes. And I know Adam said he didn't think we could do it the way we did it, and he called all of us and discussed it. But I would think that it should be in the minutes, and then it should be addressed during the next.
So how would we change the minutes?
Well, let's listen to the minutes, and then we can.
How long is it?
It's about 5.5, 6 minutes, somewhere. If I can make it work.
The amended plan, and amendments were essentially to.
All right, I'm good. I'm right close. Hold on.
Sorry, I'm pulling it up here. We're essentially to make the changes that are necessary for this committee. And if you have any questions, I think Mr. Tucker, where'd he go? Oh, there he is. Oh, do you have something? Go ahead.
Oh, I was just going to respond
to
any questions that people had about the changes. In addition, Michael Guyton, a consultant, and I exchanged some emails yesterday, late in the day yesterday. 2 additional thoughts for changes which are not reflected in the document before you, but which Mr. Guyton suggested were that to clarify that the benefit accruals, which means how many, years of that are years for used in calculating the amount of a pension benefit, ceased as of July 1st, 2020. That's because the people who were MED employees as of June 30th and went on to Middle Tennessee are now in Middle Tennessee's retirement plan. And that's not stated in the pension plan. Right now, we Michael thinks it's fine as is, but if the committee wanted to consider clarifying that in the document, we could do so and bring it back at the next meeting.
Could we move to approve it with that amended added?
Yes, you
Before
could
we
do that as well.
Okay. I move to accept the document with that amendment added as part of the proposal.
Is there a second?
Can I have a question, please?
Sure.
So what you're saying is that that'll give the employees credit for that last year?
Yes.
Because the way the plan states, if it happened June 1st, we wouldn't have got credit for that following year, but since you're going to let it be July 1st, then we get credit for that following year plus the average of the last 5 years. Is that correct?
It would be, it would end,
June 30th.
it basically ends at midnight, July 1st.
Okay.
Yeah, so or 11:59 and 59 seconds on June 30th. So you get that full credit year for that fiscal year of
Okay.
fiscal year 2020 that ended last day, June 30th. So that would be part of your top five. And so those people, those people who continued their employment with Middle Tennessee are now in Middle Tennessee's pension plan, and someone who didn't, it would basically line up with the separation of employment. It's the exact same date.
As of July 1st?
Yep.
Okay, thank you.
Okay, so you're saying July 1st at the 12:00:01 is when the pension plan ended?
Which is consistent with the sale.
Yes.
Okay, so not only they get the year of service, but they also get to count the July 1st, 2020 as in their high five for their salary calculation?
No, because as of the strike of midnight, people became Middle Tennessee employees.
It was 12:00:01.
Well, that's because there's no other way to divide up the time, but the end of MED and the end of the accruals is June 30th, 2020.
So therefore, that 2020, July 1st, 2020 does not count in their high five?
To July 30th, no. But through the end of the fiscal year.
Yeah, all the way through the end of the fiscal year.
So all of these people who just applied for retirement benefits are incorrect? Because we counted their July 1st, 2020 as their high five.
Nobody was working July 1st.
Right.
Yeah.
It can't count.
But you're doing away with a whole year by 1 second.
Well, there's really no time that accrued, it's a designated as, but there's no time that accrued past June 30th.
It's more like you're trying to count a whole year for 1 second.
Right. Yeah.
It ends June 30. June 30, 2020 is a full year, and it counts. July 1st in 1 second is not even.
But their salary at June 30th was that amount.
That's right.
That's fine.
30.
Right.
That's right.
So you're counting their June 30th.
Salary for that last year.
Okay, we're
good.
we're just confused. I apologize.
Yeah, what they
were making on June 30th, 2020
Counts, right.
will be counted in their high five.
Yes, absolutely.
Okay, thank
Yes.
you.
Yep.
Right.
Okay, thank you.
Okay.
Because Chris and I had a misunderstanding yesterday about that.
Okay.
So, sorry. I think Jackie and I understand now.
Yep.
Thank you.
You get
Okay.
a full year.
Where were
But
we?
there was not a salary increase on July 1st.
No.
That's what, I
Yes.
think maybe that was the confusion.
Yep. Okay.
And there wasn't, so.
Yep.
Chris, do you have any questions on that?
No. Lori and I got that clarified yesterday. The way that it was reported on the pension application looked like they were getting credit for 2020, July 1. But what I'm understanding is the dollar amount that is on the July 1, 2020 line is for wages that they started earning on July 1, 2019 through June 30, 2020, is that?
Those wages began the first pay period in January of 2020.
In January? Okay.
And this is something that Finley's aware of when they do the computation. They have the exact dates, right?
Yeah, we had the exact compensation provided to us. That is correct.
Okay, we'll make sure that's clear.
Okay.
But yes, the full credit through June 30. I have a motion with that amendment added to make that clear in the plan document.
And then Craig did a second.
There's a second. Any other questions, discussion? Okay.
Okay. Craig Tyndall,
Aye.
Melissa Wright,
Aye.
Ross Bradley,
Aye.
Jackie Whitaker,
Aye.
Lori Williams.
Aye.
Okay, next item is consideration.
Okay. And like I said, hold
Jackie
on.
Whitaker,
I am technically,
Lori.
there we go. Sorry. All right, and like I said, I don't, even, you know, he called us and said, well, we can't do it the way we do it, and that's fine, but I would think that would be somehow included in this minutes, and we would address it at the next pension meeting.
Well, and we can talk a little bit more about it today, but as far as the minutes concerned, there was a motion, and I think this accurately reflects what the motion is, if I followed the entire conversation on there, and this isn't a verbatim transcript, obviously, because.
No, I understand that. You couldn't, it'd be a nightmare, but.
Right, it's a summary of the motion that was made and how it was approved. So I think it, and you guys can correct me if I'm wrong, but it accurately followed what the conversation was and what the motion was and how the plan would be amended. And obviously there's been a lot of work since then, and there's a plan amendment now. We'll talk about that in a second. But I didn't see anywhere where the minutes were inaccurate, but what would you
Well, I mean,
propose? You can make a motion to amend the minutes that are being proposed, and we can vote on that, but I'm not sure how that would be amended, because all it is talking about is the motion and how.
but we really didn't know what we didn't really tie down what we were voting on. And I think it needs to include the part where it says, that we discussed the pension plan and how it relates to that last year.
Well,
I don't think that discussion affected the proposed amendment.
Yeah.
I mean, I'll say this right now. I was wrong.
Oh, and you called, and I'm
but
not saying you did.
I think people in the audience need to hear this. I made a mistake. I answered a question that I wasn't prepared to answer, and I should have said at that meeting, I don't know, and I'll get back to you. And so to the extent that my statement has created confusion, I apologize.
But I was going to include you in that, and I said
Yeah.
that. You did call us and say it, but I would think it would be addressed in the minutes.
I think it would be, I think this accurately reflects what the motion was. To the extent that you want to amend it to say there was a discussion of what the effect of the amendment would be for employees who applied for benefits after July 1st, 2020, I think that would be appropriate, but my statements about how the amendment would affect participants who applied for benefits after July 1st, 2020, did not affect the motion. It was not no.
Yeah, and in fairness, and you can defend yourself very well, so I don't necessarily need to. But
Well, he
in
doesn't
fairness,
have to.
it
He
was-
called us,
yeah,
and I understand that.
But and I know you do, but for everyone else that's out there, I mean, we were addressing a situation on the fly, and we've learned quite a bit, and this is why, as you mentioned, Adam called later, that there were other circumstances that needed to be addressed before we even got to that point. I'll short circuit this and say, what I was going to say at the end is that we understand what we're doing today doesn't really deal with the topic of the 2020 increase in January of 2020 and how that's factored in. But that's a consideration that we are taking up, and we'll look, and we're going to make proposals. I talked to Adam today. We'll make proposals to council on how to address that. But I don't think that, and you're free to make a motion if you want to amend this language, and then we can vote on it. But I think that the language in here is accurate with respect to what the motion was, and that's all that's being reflected in here. I think what you're asking for is that the context be reflected in the minutes, but this minute, no part of this minutes reflects the context of anything else because these are summary minutes, not verbatim transcripts. So I don't think there's any amendment that needs to be made to this. That's my opinion. If you have an amendment, specific amendment you'd like to make, go ahead and make it, and then we'll vote on it.
Okay, so I'm confused about then what were we amending in this motion if we weren't amending it to add the language that June 30th, July 1st salary was included?
That was not in any of the, that was not,
Part of the motion.
that was not part of the motion, and it was not part of the language suggested by Michael Guyton.
So what was the amendment that in that?
The amendment was the paper document that I had presented to you in a clean copy form and track changes, and as well as the additional language that Michael Guyton had suggested. What the question that you and others asked me was what the effect of that amendment would have on, or what the effect of the plan as amended would have on people who retired after July 1st, 2020, or applied for benefits after July 1st, 2020. It had no,
Right.
it did not change the language. My answer did not affect the language of the plan.
Yeah, the discussion ended up being collateral to the actual amendment that was being made to the plan. What was being amended in the plan in summary form was to indicate that the city was taking over the plan. And then the discussion went further than that, and that's when, Adam, we had the discussion. But this motion that's reflected in this minutes was only to deal with the amendment that was proposed in writing to this committee at that time. And again, the summary was the city's taking over the plan. That's basically what it was doing. So to a certain extent, all that discussion in there didn't have anything to do with the motion that was being presented. And I understand that's a point of discussion. And like I said, staff is going to propose on how to deal with that later because it doesn't have anything to do with the amendment that's being made here right now. So we've already had that discussion, and we'll continue to have the discussion. But again, if someone wants to make, and then let's move on. If someone wants to propose an amendment to the minutes as it's written here, then we'll entertain that. If they don't, then we'll need a motion on this so we can move on. Okay, is there a motion to approve the minutes?
Let me say this. I think we've got a lot to talk about on the plan. We clearly are going to have to change the plan. I don't think our minutes from last month's meeting is the time to do it. I think we're going to have plenty of time to talk about that here in just a little bit. I'll make a motion. We approve the minutes from last week, and let's continue this discussion once we get out of this part of the session.
You have a second?
I'll second it.
Okay, motion and second. Ms. McFarling?
And so Craig Tyndall,
Aye.
Jackie Whitaker,
Aye.
Lori Williams.
Aye.
You don't get to vote?
What's that?
You don't get to vote?
You're going to call the two of us?
What am I doing?
Call Ross.
You got to call everybody.
Yeah, you call Ross.
Oh, I'm sorry. Okay.
Melissa.
Okay, Ross.
Yeah, they get to vote.
Okay, and Melissa? Okay.
And then
It
you
was an assumed aye.
yeah, you record Ross is an aye. All right, item number 3, Mr. Tucker.
Sure. Let me just pull this up real quick. Members of the committee have already received a copy of this presentation, which should come up on the screen. There we go. And it did earlier, but I'm sharing it for members here in the audience. And also just, if anyone is interested, the document on which this presentation is based, the The full analysis document is a public record, and if anyone would like to see a copy of it, staff would be happy to provide you with a copy of it. After the city took over the administration of the MED plan, which was something provided for in the purchase and sale agreement between the city and Middle Tennessee Electric, as everyone knows, they developed some questions about how benefits should be calculated, and a lot of the concern that Mr. Whitaker just was speaking about, and that is what the effect of the June 30th, July 1st distinction for purposes of retirement, calculation of retirement benefits for those who applied for benefits after July 1st, 2020. So city staff, including me and members of the Human Resources Department, Pam Russell, Chris McFarlane, and also Erin Tucker from the city's budget, she's the city's budget director, looked into this, and we became concerned comparing looking at the plan document, the plan language, and the past plan administration. And there was evidence that suggested that there had been a deviation in the administration of the plan from the provisions in the plan document. And I will preface this that as we dug deeper into it, that this practice predates, I believe, the employment of anyone who was employed by MED at the time of the sale. So this was something that it turns out was practice was going on for, I'm going to say, at least 37, 40 years, because the practice affected Mr. Allen. So the city engaged an independent actuary, Cowden and Associates Incorporated, to identify, to assist the city in identifying prior administrative practices. And to take a step back, the reason why this is important is to identify this is the pension plan is considered a qualified plan under the IRS regulations. By virtue of that qualification, the earnings of the plan are not taxed as part of the plan. It's taxable once the benefits are distributed, but so long as the assets are being held in the plan, the gains and income of that plan are not taxable. If a plan were to lose qualification, then the income and capital gains would become taxable. That would have significant consequences for the sponsor of the plan in terms of paying those taxes, as well as potentially for beneficiaries. One way that you could lose qualification is if a plan is not operated in accordance with the plan language. Fortunately, there are ways where you can go back and correct situations where a document or where a plan has not been operated in accordance with the plan document's language and provisions. And basically what that requires is simply so long as the way it was operated was legal. It was simply contrary to the provisions of the terms of the of the pension plan. You can go back and change the plan's terms to coincide, to be consistent with the manner in which the plan was administered. And that's exactly what we discovered here and what Cowden analysis revealed. So there were two particular things that we were looking at in terms of where possible deviations occurred. One was in how years of service were calculated, and the other was average monthly compensation. Just for the benefit of everybody here, I'm just going to go over a few key terms. Compensation under the plan is defined as the annual basic rate of pay in effect on the first day of the plan year. Since 2008, maybe it was 2009, the first day of the plan year has been July 1st. Prior to that, it was August 1st. Average monthly compensation is the compensation, is an employees' or participants' compensation average over the 5 consecutive complete years, which produces the highest average within the last 10 complete plan years of service. It's a mouthful, I know. Years of service is any year in which an employee or participant works 1,000 hours. And the accrued benefit is 2 times an average monthly compensation times years of service, limited to 30 years. So one's, so that, what see there, how average monthly compensation, years of service all tie in to what an individual's monthly pension benefit will be. And that accrued benefit due to the sale was frozen as of June 30th, 2020, which is the date of separation for MED employees from employment with the city. So the 2 types of deviations we discovered, or that Cowden discovered, take that back. The 2 types of deviations that they were looking for was one with respect to years of service. For all but 5 current participants, the years of service were calculated in accordance with the plan document. There are 5 cases which will need to be addressed independently that are considered administrative errors. It was not a systematic misinterpretation or misapplication of the plan document. We did find, however, that there was a deviation from the plan document with respect to the average monthly compensation. Basically, what it said was that we found that the rates of pay for the partial plan year in which an employee's separate employment were included. I'm going to try to, here's an example. An employee separated on employment on September 5th, 2015 during the July 1st, 2015 to June 30th, 2016 plan year. The last plan year of service under the plan document began on, last complete plan year of service began on July 1st, 2014. Under the plan document, the basic rate of pay in effect on 7/1/24 should be the last compensation amount to be used in the 10-year history for determining average monthly compensation. However, the basic rate of pay in effect on July 1st, 2015 was included. So basically, you know, what the way the plan was being administered was that people were looking at what the person was making on the date that they retired or separated employment, and then went back for the previous 4 years. So, and that's what would happen here on this, with this person who separated from employment on September 5th, 2015, is that July 1st, what they were making on July 1st was included July 1st, 2015. However, under the way the plan was written, it shouldn't have been included because 1,000 hours had not been worked. And it should have gone all the way back to July 1st, 2015, or 2014. So what was the impact of this deviation in average monthly compensation? On average, monthly benefits calculated for current participants were overstated by 4.3%. Important to clarify here, no participant, no beneficiary got a lesser amount of benefit because of this error, and that makes correction a lot easier. All the errors were made in the favor of employees. So those, the range of these errors range from a 1.4% increase to a 12.1% increase. So with respect to the beneficiaries that we looked at, which were only current beneficiaries, an excess of approximately $460,000 had been paid to existing retired participants and surviving beneficiaries since the date of benefit commencement for each. So little under $500,000. So this error has an effect on the plan's funded status. So as of October 31st, 2020, which was the last available account statement when Cowden conducted their analysis, the market value of the plan assets was $28,124,000. The funding liability, if the terms of the current plan document had been followed, would have been $22,267,000. That is, so that's a funded ratio. It's overfunded by 26%, which is a good thing. However, the funding liability following past administrative practice, which is where we really are, is $23,234,000. So that's a difference of $967,000, which means the plan is still, is overfunded, which again is a good thing, but it's overfunded by 121% as opposed to 126%.
Wasn't the plan, though, wasn't the calculation based on the calculation and the money put in there based on these figures, though, so it is covered?
It is covered, yeah. There's not going to be a need based on this, the past practices of administration. There's not going to be a need to put more money into the plan. And yes, the actuarial calculations in terms of what needed to be contributed was being made based on what the outflow was going to be. So, yes.
Adam, I've got several questions.
Sure.
And you may not be able to have the answers to them.
Okay.
I'll tell you, when I started seeing all this, I was extremely frustrated. I was mad. I've chaired the pension committee for 4 years while I was on the MED board. And we oversaw this with the rest of the board. And every year we hired Pinnacle to manage the funds, and I think Pinnacle's done a good job with that. And every year we hired a third-party company, Finley, to audit our books. How come Finley didn't pick this up when they did their audit to see that the plan wasn't being implemented the way it should have?
They were relying on the salary data and the census data that was being provided by MED on an annual basis, is my understanding. And so where I think the error, and it was a long historical practice, was that they were providing they were providing the 5 years for people who applied for benefits. So would go to Finley and to do the actuarial benefit calculations. And my understanding is that the 5 years, the high five, would be provided by MED employees to the outside consultants. I don't know if anyone ever went back in the previous 35 to 40 years to look to see if they were providing the right 5 years.
So was it MED employees that were administering the plan, or was it a third party that was administering the plan?
It was a little bit of both. So the third parties were not auditing my understanding,
I'll answer.
okay.
Finley provided a worksheet to Murfreesboro Electric annually. And in the worksheet, it asked for the July 1st salary. It did not ask for an average. It asked for a salary as of July 1st. And that was what we provided them. And the study that was done for 2020, which is the last actuary study, is based on the salary that was in effect on June 30th. So the actuary study that we have for the June 30th does include the salaries. So it is, the calculations were done by providing the information that Finley asked of us.
Well, I feel personally responsible being the chairman of the pension fund for the last 4 years, and we've got a deficit, and either we missed the audit or we didn't have good information. And I'm not okay with that. I think that's a problem. And we got a bunch of people in the audience right now that are potentially having to pay the price for it. And, you know, I think we've talking a lot about what's going to be the best 5 years for people that just transferred over. But I think we also have to think about all the people that have been paid wrong, that are they going to claw back their money? So we've got two issues. And it's a tough situation because you say, well, we'll just make everybody happy. Well, we can just make everybody happy, but at the end of the day, we have to make sure that the pension plan has got enough money to be able to support everybody forever. And I know that a lot of people look at this and you say, well, we're overfunded 126%, and you just reported some numbers that it drops to 121% if we go ahead and update everything. I think the thing that we have to keep in mind when we talk about an overfunded pension account is it's based on assumptions, okay? So if our assumptions are not correct, that 121 or 126 is not the same, okay? So if it's my understanding the 126 or the 121% overfunded is based on a 7% return. Is that correct?
That is correct.
Okay, so we're basing that on a 7% return. Now let me tell you, one of the qualifiers of our pension is that 40% of our pension has to be in bonds, okay? That concerns me from the standpoint that the bond rate, based on where today's interest rates are at, is probably not going to get the same return as it has gotten over the previous 10 years based on where interest rates are at, okay? So I want to caution everybody because when you look at it and you think, well, we're overfunded, what's the big deal? Let's just clean this thing up. We still have the money in the account. We have the money in the account based on the assumptions that have been made by our consultants, okay? So that's why this is a big decision. We're between a rock and a hard place here, and we've got to make sure that we take care of our employees. I think that's a number one issue. But I also want to make sure we have money left over, right? My intentions are not to try to claw back any money, and I think we need to figure out a win-win for everything. But I'm deeply concerned about it. It's my understanding, and I'd heard rumor, that if you recalculated that 7% and did it based on a 6% return, you go from 121 to maybe like 106 or less.
Is
that correct?
It is in that neighborhood. I would have to go back through my emails to get that number. Yes.
If we drop below 100%, that means we're not fully funded. We no longer have a funded pension account, okay? That's important. My fiduciary duty, in my opinion, being on the pension board, is to make sure everybody's pension plan is healthy and everybody's being paid. That's a tough decision because I want to make sure everybody's paid what they thought they were going to pay, but I want to make sure that everybody gets paid over the long run, your pension that you expected to get paid. So I'm concerned that we've been making decisions as an MED board, as a past MED board for a long time with information that wasn't good information. We should have probably re-looked at how much we were contributing in that pension fund had we known that we had some shortfalls here.
In the last 7 years, we have overfunded $5 million. And if the city doesn't close the fund out in the next 28 months, who's responsible for it? If there's a shortfall, who's responsible?
The employer, it would be the city.
The city would fund it.
Yep.
I think I want to clarify
Sure.
that the audit that was done, that they found that there were, 7 errors. Of the 7 errors, 5 of them were made in the years of credited service.
Yes.
Okay, no, I mean, there were only 2 people that have been paid incorrect amounts. So all the other people have gotten the correct amount.
No, that's your interpretation is misreading that table. I would say
Go
that
back to, you mean because of the average?
they're probably about half. If you look at about 1,000 hours, because that's the distinction here, is you have 1,000 hours in the plan year. 1,000 hours from July 1st gets you to right about the 3rd week of December. So roughly 50% of plan participants got a greater benefit than they should have. Those who, retired sometime between or separated from employment sometime between January 1st and June 30th, over the past 40 years, got their benefit calculated in accordance with the plan document. It's the people who retired or separated from employment between July 1st and January, or not, and December 31st, where the overpayments occur. Because it was not overpayments in accordance with the plan document. They were all calculated consistently. It was just not in accordance with the language of the plan.
Okay.
And again, the reason of that is important is for purposes of being qualified plan under the IRS regulations. Because the benefit, and if you don't mind, I want to get back to this last page here that you mentioned, but I want to get to an important point that Mr. Bradley raised, and just to put it out there, the proposal that is being recommended to that has been recommended to me, and that I'm recommending to you, is that the plan be amended so that it is consistent with past practices. So what that means is those people who I just mentioned retired between July 1st and roughly December 31st of the plan year will not be asked to pay back any benefits or see a reduction in benefits because of this error. Rather, what we will be saying, what the amendment to the plan will be is simply to change that calculation and to basically say, in the simplest terms, is what you were making on July 1st of the last plan year in which you worked is going to be included in your high five. Whether you worked 2 days, 180 days, or 365 days, that what you were making on July 1st, the last July 1st you worked, is going to be included. So the alternative way to correct this, if we don't do this, and to maintain qualification under the IRS regs, is to go back and ask employees or beneficiaries to pay back. They're not under really, the extent to which we could require that and somehow go back and collect it is questionable. But if the benefits were not paid back, it would mean that the city would have to put the plan back financially into the same place as it was, but for that error. So that would mean that the city would have to put in at least an additional $500,000 to the plan to correct the error. And the second part of that type of correction would be that beneficiaries would see their benefits going forward go down because they would be, or at least half of them would, because they would have to be calculated in accordance with the plan. I don't think anyone wants to go down that road. No, and so the proposal is is to the benefit of the employees, those that were calculated incorrectly, we're just going to adjust the language so that the way that they were calculated is consistent with the amended plan language.
So in doing so, we're not going back and clawing back money from anybody?
No, absolutely not.
If we don't do anything, then we're potentially, IRS could terminate the plan, which would be catastrophic, because at that point, all the tax savings you've had would be clawed back and any leftover money would be dispersed. So we absolutely need to take action. I'm not in favor of going back and clawing back money from anybody. So I think that's the first thing we've got to figure out. I think we're going to have to figure out this is my opinion.
Yeah.
I think it's a tough situation to be in, whether or not MED employees can count 2020 as their year. I think we need to figure out a solution for that. I'm concerned, being on this pension committee, that if we continue to take money out of this pension, that we're going to get ourselves in a situation where if we're at a 6% return or we reevaluate the numbers, we may not be fully funded anymore. And I'm concerned that if we keep taking money out, so my recommendation is I would love for council to look at a way that we can go back and calculate what this last 2020 pay period would be for the old MED employees before they transferred over, and see if we can do a way to do a one-time payout to those people.
That is certainly something that I think staff is thinking about, and certain council members have asked that question of me. I don't have the number as of today, but the thing to clarify is that type of one-time payment needs to come from the general fund or some source of funding other than the pension plan, because if it comes from the pension plan, you're making the qualification, you're raising another qualification issue, because you are treating the people who separated from employment on June 30th, 2020, different from someone who separated from employment on June 30th, 2019, June 30th, 2011, June 30th, 1991.
So we're actively looking. It's a complex question, and we're getting into it. It requires actuarial, so that is underway. So we'll get some data from that, and then, as I said, formulate a recommendation that we'll take to council, and whether it's inside or outside the plan, we'll have to figure out.
I don't think there's anybody that happened to, because PD would be across the table from you and saying, you need to work one more day.
Yeah.
So I don't think that subgroup exists. I think there's negative people in there.
No, there are. You would be. I'm not sure that's exactly true. I do know there's someone who does have a June 30th retirement date that prior to June 30th, 2020. I don't know why that person retired on June 30th, but the person did. For the exact reason that you're stating, why wouldn't the person wait one more day? but I know of at least one, and having looked through the records.
But I've gotten some phone calls from some different people, and I think one of the comments that I've heard is that, well, this sale occurred 1 minute before I could have gotten my 2020 pay period. I haven't talked to anybody, I don't know anyone at the city that says, yes, we saved ourselves a bunch of money because we closed 1 minute early. In fact, the document I saw has us closing on July 1st. So I don't think that, and I want to say that for everybody in here, I don't think there's anybody at the city that's sitting here saying, we're going to try to do everything we can to get a gotcha by closing this transaction 1 minute before you would have gotten your 2020
I don't think anybody here thinks that either. It's just something this complex, there's going to be issues. There's just no way you can think of everything.
Yeah.
So what we've got to do is decide how to make this right, because we did work the whole year. I mean, every minute of that whole year, so we should get credit for it, however that transpires. But nobody here is thinking that the city did that. I mean, it's just so many intricate things that had to be gone through. And it wasn't, you know, and I'm sure the city and Mr. Jones too, and Middle Tennessee Electric would have bumped it back a day if they knew there'd been this issue. It might have been a little more aggravating on the accountants. That's why they picked this date. They'd have to do 1 day, I guess, into the next year for accounting. That's why it was picked. But it wasn't done. It wasn't done with malice at all. And we don't think that. It's just, how do we get credit for it? That's why they're here.
Well, and we are working on that. So I think though the discussion today is how do we correct the pension plan to accommodate what was done incorrectly in the past, and I think we've found a path to do that for a majority of people. I think there's a few outliers.
Right, and I can address those in just a
that
moment.
Adam can talk about, but right now, if we can clean off the most of it, we're in the analysis on the part which, for lack of a better term, let's just call it January 2020, and how that factors into going forward, and we'll continue to do that and bring something to council in the next few weeks.
Yep. I just want to Ms. Williams' question about the other miscalculations that we were identified as administrative errors that will need. The amendment captures 97% plus of the issue. There were in Cowden's analysis, in the actuarial analysis, they identified 6 individuals who had their benefit miscalculated for some other reason. And almost all of these situations each of these situations is unique, a unique set of facts, and sometimes it's not some of the things were complicated in terms of how the calculation was going to be made. So of these, 7 people, there's one who was still listed as a term vested employee in the participant census. However, that person had taken a one-time lump sum payment distribution when she separated from employment. So she should not have been on that census anymore. So that's the one. So she's been fully paid and fully received her benefits. She voluntarily accepted that lump sum payment.
She didn't receive any distributions before.
No, she didn't receive any. She's well below the age of eligibility for retirement. So at the time, her benefit, it was going to be less than $10,000. So she just had it rolled over into an IRA. In that one-time lump sum.
It sounds like to me we weren't reviewing the way the plan was being administered properly. We should have done a better job auditing the way that it was being administered. Adam, now that the city's got the plan, what's the city's policy for making sure that the plan's being properly reviewed and administered correctly?
Well, I think the first that can I get back to that just finish these 6 people and then get back to that question. So 3 people who are term vested employees. That means they separate, they were vested in they were participants in the plan, they were vested and eligible for benefits, but they separated from employment before they were eligible to retire and start receiving benefits. Cowden and Associates identified 3 individuals who should have received additional years of service credit. So those 3 people will actually see an increase in their benefits when they apply for them. There was one term vested employee who received 1 year too many of years of credited service. And then there were 2 retirees. Oh, and then there was one retiree who received 1 too many years of credited service. And there was one retiree, and I think this one goes back 25 plus years, where there was an incorrect rate of pay included in the average monthly compensation for reasons unrelated to the error that we were talking about, that we spent most of our time talking about. That one term vested employee and the 2 retirees will see a decrease in benefits going forward. We're not going to ask them to pay back anything. We don't feel that's appropriate. However, I don't want to identify those individuals, but I will say that staff have been authorized by City Council to try to make up that difference from another funding source other than the pension, so that does not negatively impact those individuals going forward.
Okay.
So
how do we avoid this in the future?
Well, one of the things is that the first step is that after we amend the plan, is we submit the plan to the IRS for determination of the plan's qualification. So basically, we explain the issue, the correction that we made to the plan document, and so that sets it going forward. In some ways, it's going to be easier going forward because we know these types of errors are not systematically going to occur again, or should not occur again, because we know what the high 5 are, and that issue will be decided, and it will be clear. I think it will be worth probably as a check is that city human resources, which is administering the plan now, that they provide the documentation for that high 5 and the calculation of the years of credit or years of service, that is reviewed by the legal department, and that the actual supporting documentation is sent with the relevant compensation history to the consultant and the actuary. So you basically have 3 eyes looking at it to make sure this is consistent. Now, if something's wrong in the record, the electronic or paper record, it's hard to correct for something like that, but at least you have 3 people saying, yes, this is
Additional checks and balances.
Yeah, these are the numbers that are being used are consistent with the definitions and calculations required by the plan. That would be my recommendation. And then, and again, continue with annual audits.
We lived in our world, so we don't know of any other plan and all that. Has the city ever done a thorough investigation of their plan like this? I'm just asking for information.
I don't know the answer to that question. They have not done one since I've been city attorneys, which is about 2.5 years, but they do, maybe Melissa or Chris would be in a better position to answer that.
They're included in our audit by our audit firm.
just like this was.
Yeah, but beyond that, I don't know that we've gotten into a detail.
Because over these 40 years, there's going to be some mistakes. It's just, and I'm not I'm not saying it's right or wrong, but there's going to be mistakes in plans. That's why the IRS has a means to adjust these.
Exactly. And I think, there's the audit level, there are different levels of audits.
That's right.
And this level of audit required the auditors, or the actuaries, to look at each participant's personnel file, earnings history, service history, and pension calculation worksheets. I mean, it was a document-intensive endeavor to do this. And the type of financial audits that are done this goes well beyond the standard annual audit that's conducted of a pension plan. This was an investigative audit.
Was this paid for out of the pension plan?
No,
It was not. Okay.
it was not. It was just funded. This is a plan sponsor expense, and it would not be consistent with the IRS regulations for this to be paid out of the pension fund. There are certain administrative expenses that are permissible to be paid out of the pension fund, but this is not one of them. Specifically, corrective actions to the administration of a plan or to plan language are not. That is the legal obligation to pay for that is on the employer.
I know I got on the IRS website and looked at some of this. That's an hour and a half I'll never get back. But yeah, there are means on there, because there's going to, we're human.
Yeah.
There's going to be mistakes made.
Yeah. Does anyone have any questions about the report and the issue before we move on to the actual proposed amendments to the plan?
Do they not recommend fixing this in the plan document?
Oh, it will be. That's the amended plan. One of the most important fix amendment in the document that we'll be discussing in item 4 addresses this issue. We okay to move on?
I think so. There's no questions. Go ahead.
Okay. So the next item is to consider an amended and restated version of the Murfreesboro Electric Department pension plan. This is in many ways very similar, and it still contains the revisions that you voted on back in July, but I want to highlight a couple of changes that have been recommended based on the Cowden's analysis, as well as some input provided by the attorney that the city engaged to assist us with this, Andy Elbon. He's an employee benefits specialist with Bradley Arendt, Bolt Cummings, as well as by Michael Guyton. So the document is presented to you in track changes. The first one, if you there's on page little Roman numeral I, that's just changed the preamble to be consistent with showing the city as the employer as opposed to MED. I've also provided you a sheet with some suggested changes. Again, these are from Mr. Elbon and Mr. Guyton. In what I provided you, there was a proposed amendment to 1.1 that says, in no event, however, shall any benefit accrue under the plan after June 30th, 2020. It's the legal recommendation of Mr. Elbon that that line be deleted. In fact, that is what is happening. There's no one employed by MED to accrue benefits. And the reason he suggested that it be deleted is that when this plan is presented to the IRS to review, they might read that and say, oh, what does this have to do with? And that it might create an issue that we have to go back and explain. Now, there is a good explanation for it, but it would just make the determination process longer and require more back and forth. It doesn't substantively change anything because there's no MED employees. There's no way for anyone to accrue benefits. But we don't want to create a question mark where there doesn't need to be a question mark. Okay. The next edit is to the average monthly compensation, and that would, you can see in the document that was at your seat, that changes the definition of average monthly compensation to read as follows. Average monthly compensation means 1/12 of our participants' average annual compensation, where average annual compensation equals a participant's annual compensation average over the 5 consecutive complete years of service, which produced the highest annual average within the last 10 complete years of service, provided, however, that purposes of the foregoing, the participant's annual rate of pay as of the first day of the plan year that includes the date of the participant's separation from service shall apply regardless of hours of service actually completed in such plan year. It's that last language, starting with within the last 10 years to the period, that corrects the error with respect to average monthly compensation. Because the effect of that language is that what you were making on the last July 1st you worked is what's going to be included. One other thing is in the definition of board 1.8, there's a misnumbering. That definition of board is going to be moved simply to 2.1, which defines the employer acting through its board, which is the city council. And that is being pulled out of there because there was a misnumbering in the document, and to try to renumber it in the definitions will require going back through the entire document and changing all the references to the definitions. So where it says, as compensation is defined by section 1.9, we would have to go back and change that so everywhere it appears it's 1.10. So it's just a cleanup for that. Everything else, all the other changes that are presented here, you approved in July. And I'm happy to address any questions you might have, but my recommendation is that you vote to approve this amended and restated plan and recommend its passage to City Council, after which the staff would work to submit the plan to the IRS for a determination as to the plan's qualification.
Any questions?
Any questions? We have a motion.
So Adam, you're telling me that when we do this, it's a lot of technical language, and I don't have the full packet, that everybody that has kind of been squirrely gets fixed, nobody has to pay any money back?
No,
Or
no.
anybody that does, the council's going to take care of it outside of the pension?
That's right.
So by doing this, we make sure we get straight with the IRS and everybody's good. This doesn't address this doesn't address 2020.
No, it doesn't address the June 30th, 2020 versus July 1st, 2020 issue.
Yeah, the way it's written, it would exclude that year.
Right, and again, that it has to be written that way, because otherwise we would be creating two classes of beneficiaries under the plan. Those who retired or separated employment before June 30th, 2020, and those 60-some individuals who or participants who left on June 30th, 2020. They would be treated differently, and that creates a legal issue for the plan if you were to create those two classes.
And you're 100% sure that there would be one person that would meet that qualification?
I would.
If there's not, then you can't hurt anybody if we put the language in here.
But that one person was certain circumstances that they retired June 30th.
It could have been. Yeah, it could have been.
It was to their advantage to retire June 30th.
Okay.
I will approve this with one condition, that we go back and look outside of this language for a way to try to address the 2020 service year.
Yeah.
Outside of this board.
Yeah. I'm going to put my city attorney hat on as opposed to presenting this. I would say that approve this and then probably have a separate motion to make that request or recommendation to city council, if that's what.
I'll make a motion, we approve this language.
Can I amend his motion to approve that now?
Do we have a second first?
You need a second first.
Second it.
Okay.
Okay, I would move that motion to be amended by adding the language, as a result of the sale of Murfreesboro Electric Department on June 30th, 2020, this date becomes the last applicable rate of pay for determining average monthly compensation for the 43 active employees and plan participants at the time of the sale.
Is that a motion? You move, it's an amendment. Do we have a second for that?
A second.
So let me ask a point of clarification on that. If we do that, does that increase the $900,000 you mentioned earlier in your report? It was going to cost $900,000 to get everybody caught back up. If we do it, change it to 2020, does that change that number?
The actuary study was based on those figures.
Okay.
Could you reread your amendment? Or
As a
could you
result-
provide, could I look at it?
Sure. I mean, wouldn't it be better to go ahead and include that for the IRS to review the plan?
I would say that this language has been recommended by someone who specializes in, an attorney who specializes in pension plans. And I understand that is clear with respect to the individuals who were employed by MED on June 30th, 2020. I think that's a statement that would be included in, should be included in any communication with the IRS. But I think it suggests, I think it might also create an issue with respect to, or create a question as to, are we creating another class of beneficiaries by referencing something that occurred on.
Could we ask for their opinion?
Well, we're asking for an amendment. Right now, the motion is to amend what we're going to propose to the city council. And so if you want to withdraw the motion, we can go forward with the original. If you don't want to withdraw it, then we can vote on that up or down. Now, I will say, as a point of discussion, that it has not been vetted through our attorneys. I will also say from experience that we do not want to take 2 or 3 or 4 shots at the IRS. We want to take 1 shot, and we want to get it right, because that's going to make things a lot more difficult going forward. So the proposed language that just showed up today, I don't think that, in my opinion, would be a big mistake to correct this plan. We've spent a lot of time, Adam and his attorneys spent a lot of time to correct the past mistakes by proposing language that we can submit to the IRS with a degree of confidence that it would be a self-correction, it would be recognized. And it sounds like the attempt here is to do what we've already discussed that we need to do more work on, and that's to deal with the 2020 issue. And so we're going to do that going forward. So we have a motion and a second. If there's no more discussion, we'll vote.
You have an amendment.
Yeah, on the amendment, that's what I meant.
Was there a second?
Yes, Jackie.
Okay. Okay.
Lori, is the intent of changing the motion, is it to try to get 2020 as the last year?
Yes.
Okay, so basically, your best 5 years are 16 through 20, is what you would like to amend the language
We
to
would
say.
drop our worst year, which would be year 6.
Right.
50.
And, I mean, the person that retired on June 30th had the opportunity to retire on July 1st. We did not have that opportunity.
But that's, creating the second class is the issue. Regardless of the circumstances that do it, if you create a second class, you're running into an issue. I mean,
I'll tell you that I've discussed this with a pension expert attorney. We discussed it with the actuaries with Cowden and Associates. Based on my conversations with me, from a legal standpoint, I don't know exactly what the IRS would say, but I do believe including that language could raise questions that makes the qualification process more difficult, and that the appropriate way to handle the June 30th versus July 1st, last day of employment question, which really, what's the date of separation, is to do it completely outside of the plan, and to not put anything in this document that suggests a creation of a second class of beneficiaries under the plan.
So you're saying that this cannot be fixed in a pension plan, and that the last year would have to be addressed outside the pension plan?
That's exactly what I'm saying. That the concerns that you and others have expressed to me about whether the MED employees who had their last day of employment on June 30th with MED, whether they should get credit for what they were, making at that time and have that included, I would not recommend addressing that in the pension plan. That needs to be addressed. That needs to be addressed outside of the pension plan. So what this would say is that for retirees or for participants who were employed by MED on June 30th, their high five are going to be July 1st, 2015, July 1st, 2016, July 1st, 2017, July 1st, 2018, and July 1st, 2019. Assuming no one actually has a different high five. That's assuming that the last 5 that you were employed with MED are your highest 5. And that's the way it's calculated because that's the way it's calculated for everyone else under the plan. And that if there is still concern, which I understand that there is, about whether that is fair and meets the expectations of MED employees, that concern needs to be addressed outside of the plan.
But this is a motion that we're just presenting it for city council. What we're approving is to go to city council to be approved.
Yeah, yes, yeah. Yeah, city council it has to approve this because they are the employer.
So they would discuss it, if we left it, if we voted and it went in, they would discuss it, you'd advise them to let it out, but at least we'd get it, I mean, this council would talk about it.
Yeah, I mean,
Yeah.
they could.
Yeah, I mean, I'm just,
Well, yeah, I guess that's true, but I personally am not going to vote for something that I expect council just to talk about as opposed to amending a document itself to present to them and then tell them, we really don't want you to do it, we just want you to talk about it. They've already committed to talk about it, staff's already working on it. I think that's sufficient. Unless there's any other questions, let's vote. Okay, Ms.
Yeah, I'm not comfortable approving language that we don't know that the IRS is going to approve, based on the fact that I've had multiple conversations with council members that are willing to do something to address this, and that's the reason why I'm going to vote no on that.
Okay, Ms. McFarland?
Are we voting on the amended motion?
We're voting on the amended.
On the amended
On the
motion.
Amendment, right,
Okay.
yeah.
Craig Tyndall,
No.
Ross Bradley,
No.
Melissa Wright,
No.
Jackie Whitaker,
yes.
Lori Williams.
Yes.
Okay, so we have a motion and a second, I believe, on approving the plan language as it's proposed by Mr. Tucker. Ms. McFarlane?
Okay, Craig Tyndall,
Yes.
Ross Bradley,
Yes.
Melissa Wright,
Yes.
Jackie Whitaker,
No.
no. Lori,
No.
Okay, thank you, Mr. Tucker. Next item is for information for the board, the MED pension plan asset and allocation as of September the 30th and December the 31st. And then there is a defined benefit financial security act 2014 compliance letter from the State Department of, State of Tennessee Treasury Department. Any questions or comments on those documents? Okay, hearing none, any other business from the board?
I'd like to move to establish holding MED pension quarterly meetings and for the committee members to receive monthly Pinnacle statements.
It's a motion, is that a motion? Second?
I second.
Okay, Ms. McFarlane?
and Jackie, you did the second.
Yes, ma'am.
Second.
Okay. Craig Tyndall,
Yes.
Ross Bradley,
Yes.
Melissa Wright,
Yes.
Jackie Whitaker,
Yes.
and Lori Williams.
Yes.
Craig, if I could say one more thing.
Sure.
I know that there's a lot of Middle Tennessee Electric employees in here now that have transferred over. I'm not a big fan of mistakes recurring more than once. So ahead of this meeting, I went ahead and scheduled a meeting tomorrow with Chris Jones and Chairman Woods to talk about how we're auditing, because I know with the transfer, all of y'all became fully vested in the Middle Tennessee Electric's pension plan. So I have set up a meeting tomorrow to talk to Chris and Chairman Woods about how we can make sure that our plan is being audited on how it's administrated. So I want to make sure that this doesn't happen again on that future plan. So I just want to let everybody here know that.
Thank you, Mr. Bradley. Any other business from the committee? Committee stands adjourned. Thank you.